when the Federal Reserve said we'll keep rates low through 2023 and basically told you they'll keep rates low through 2024, why the jitters in tech off the back of that?
It sounds crazy. I think that it's just noise. First of all, if anybody believes that the Fed has a crystal ball on what the world is going to look like out in in 3 or 4 years from now, what they're really trying to say to people is, if you didn't think we were really, really, really serious, now we're one extra really serious. The Fed is telling you that they can't even imagine raising interest rates anytime in the future, and whether they say that out to 2022 or 23 or 27, the market should probably just be ignoring. As far as tech is concerned, I think that growth stocks, and even more than just tech, but growth stocks, I think are going to be the theme going forward. This was a pullback and a breather. It was a reasonably harsh one. I mean, if you look at growth versus value, an 8% spread in returns in only about 2 weeks. If you look at the top 5 companies in the S&P underperforming the rest of the S&P by 8% in the last 2 weeks, but you're also starting to see hedge funds and others nibbling to say, hey, maybe this is an opportunity to get some of these names a little bit cheaper and ride the next wave.
John, I remember you and I were in the room together, actually, around the same table at the Economic Club in New York when Chairman Powell delivered that address, and he talked about financial instability. That was a different man. That was a different person, because shortly thereafter, with the sell-off going into the back end of 2018, this has been a Fed that's been much more proactive to support financial conditions, and it predates the pandemic. But, John, what I think is interesting about your call is you think this is a Fed that, yes, supports financial conditions, but supports one part of the equity market more than the other. Do you think the Fed's position and what they're basically communicating to market participants complicates a rotation away from growth and towards cyclical areas of this market?
It's a great question. I think that if you're going to see a cyclical rotation into the market, it's going to have to be driven by near-term economic success. And that's going to be driven by, I think, 2 things. First, number one is you need a vaccine that's going to get people out of their houses and spending money and to open up cities and offices in a way that we haven't seen. So that's number one. And number 2 is, and I'm not a fan of just endless stimulus, but if we saw another aggressive stimulus package, that could also boost people's spending. There's a lot of the PPP programs and the unemployment programs that are rolling off, in the last month, over the next several weeks, that are going to take a bite out of the consumer, and you're not going to have anything which looks like cyclical leadership in the near term, especially since we're not going to have a vaccine tomorrow, without the government boosting up the consumer and business spending right away. So my take is, in the absence of vaccine and the absence of something really large from the government, that you're going to have growth assets and stable cash flow companies. These are consumer staples and healthcare companies, things like that. Those are the names that are going to do well. And industrials and materials and banks are going to struggle more in that more lukewarm, weak economic environment.